Okay, fun seekers, we are going to attempt to do that which is impossible to do. Oh well, we must we must do our best. And that is to get our arms around this industry, to get our arms around the thousands of different mutual funds that are out there. And so we're only going to look at the major classifications, the major categories. And what I hope you will do is go to the website or through Canvas and get a copy of the mutual funds types scramble sheet. And so here it is. And have this printed out just because it gets very confusing very quickly. So this document should help you. No guarantees. Okay, we're going to go from the most riskiest types of mutual funds to the least riskiest. And then we'll take a look at some odds and ends afterwards that don't fit well into this spectrum of risk versus return. And of course, the most riskiest mutual funds are stock mutual funds. Well, there are a few categories that are even higher than more risk than the ones we're going to look at. And so we're not even going to discuss those. The most riskiest funds are aggressive growth funds. You'll see names like Ultra and Pro Ultra and Momentum and just stay away from these things, folks. Now, that doesn't mean you shouldn't have a little bit of an aggressive growth fund. I'm going to use an analogy, and if it works, great, and if it doesn't work, throw it away. I'm going to think of a buffet, the buffet counter. When you take your plate to the buffet, do you load it up with jalapeno peppers? No, you put a little bit of very spicy food on your plate. And that's what these aggressive growth funds are. They're rolling the dice, folks. They should do well when the market's doing well, but when the market hits a turbulent patch, they will fall like a stone. And herein lies the problem. The company will call a meeting for the 401k participants and the jerks. I mean, the brokers in their beautiful suits and their gorgeous haircuts will come and tell how wonderful the darn thing is. And you'll be looking through the materials and you'll see this aggressive growth fund or whatever name it goes by. And you'll see that it's done really well over 10 years or 20 years or whatever. And so that's the one you want. I'm going to put all my money in that one. Well, did you look at the standard deviation? Huh? In the industry, we don't really have a good way to measure risk. And so we use a concept from statistics. Some statistics called standard deviation. And I don't ask you to learn about that. If you take Business 123, Introduction to Investments, oh yes, you're going to have to learn about it in detail. But what I'm trying to say is that, yeah, this thing does well over time, but there are times when it loses 50, 60, 70%. And do you think the people who have never put a dime away are going to sit there while it's falling and falling and falling? Ooh, is it too late to get out? Yeah, it's too late to get out. Now's the time to put more money in. So my recommendation is no more than 5-10%. Or, in fact, 0%. I mean, that's what I normally recommend to people. But if you want a little bit of spice, then go ahead, put your money in an aggressive growth fund. The next category is the growth fund. Well, how's that different? Well, it depends. And, it's in beauty is in the eye of the beholder, and aggressive growth and growth are in the eye of the beholder. And some growth funds are just as risky as aggressive growth funds, and some are not. So see what you're up against? Subtle differences. But these will have some provision in their prospectus, which is the document that outlines how it's going to run how they're going to run the mutual fund, that says we will invest primarily in companies that are growing. So it's risky. Not as risky as some of the aggressive growth funds, but still can be very risky. The next category is where things start to get a little weird. In fact, if you go to the mutual fund scramble sheet, I did my best to try to show you that the capital appreciation funds exist around the aggressive growth funds. They are lumped in with the growth funds and the aggressive growth funds, but they are very different depending on the company. See what you're up against? Capital appreciation funds tend to be far more flexible. A growth fund will invest primarily in growth stocks, but a capital appreciation fund can invest in any kind of stock. Remember, we talked about cyclical, defensive, income-oriented blue chips. They will invest in any kind of stock that could generate growth, that could generate capital appreciation, which is a fancy way of saying the money goes up. It's worth more. So we might use the phrase, they paint with a broader brush. Whereas a growth fund, an aggressive growth fund, will mostly go after companies that are growing, the capital appreciation fund will choose companies that may not be growth companies. And so you say, well, wait a minute, aren't you supposed to be a growth fund? No. We're a capital appreciation fund. And to make matters worse, one of the largest and longest term growth funds in the country, in the United States, which is the one we used in Chapter 12 for our illustrations, is called the Growth Fund of America. It's a capital appreciation fund. And if you go to the Growth Fund of America and say, why are you guys calling yourself the Growth Fund of America? Shouldn't you be called the Capital Appreciation Fund of America? They would say, excuse us. We were the Growth Fund of America before the industry started making the distinction between growth funds and capital appreciation funds. So you guys are the ones who change, not you're the ones who should change, not us. You see what you're up against? Yeah. So if you see a capital appreciation fund, you really need to dig deep and make sure they are truly a company, a mutual fund that paints with a broad brush. In fact, one of the most famous capital appreciation funds is called Fidelity Magellan. And it was run by none other than Peter Lynch, who we talked about back in Chapter 12. And because he had a mandate to be flexible, he found value and good investments in all types of companies. He just had that knack, that sixth sense for sniffing out value, and did very, very well. It's never returned to its glory days of the 1977 to 1990, but still, that's the idea. Then the next category is called growth and income. Now, this is my favorite. And if you were to ask on an exam, for example, which kind of fund you would like, hint, 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 if you choose growth and income, you're not going to make your professor sad, that's for sure. This is a blend of growth, capital appreciation, companies that are growing, and dividends. Now, why don't they call it growth and dividends? Don't ask me. I don't make up the names. This is the pasta. This is the potatoes, the mashed potatoes and the lasagna. This is the main dish that, in my humble opinion, you should put at least 50, 60, 70 or more percent of your investment into. In fact, this is my go-to investment for people just starting out. Especially if they're not really young. If they're young and then you're 20s and you might want to do a growth and income and a growth, you decide. But you won't go wrong, especially with a well-run growth and income, because that's the blend, as they sometimes call it blend funds. Sometimes they're called value funds, but you have to be careful because value means something different depending on who you are in the investment world. Value usually means companies, not always, that are undervalued compared to the market. So let's see what you're up against. And in the scramble sheet, I did the same thing. I tried to put value and blend around growth and income. You see that? So this is what you're up against, folks. My apologies, but that's the industry. Growth and income funds are often called value funds, often called blend funds. They're moderately risky. And what does that mean? Well, we'll discuss it in the next presentation. But where an aggressive growth or a growth fund might lose 50, 60%, Capital Appreciation Fund might lose 50%. The Growth and Income Fund might lose 35, 40%. Now, it doesn't sound like a big deal, but think about it. How would you like your $1,000 to become $500 or $700, $650? How would you like your $10,000 to become $4,000 or $6,000? That's the kind of downside protection that a growth and income fund will give you. If you're even more worried about that 10,000 becoming 6,000, you may be interested in an equity income fund. Now, again, I didn't come up with the name. Equity is another word for stock. Income from stocks is dividends. Why don't they call them stock dividend funds? They don't. These mutual funds invest in companies that emphasize dividends. Remember we talked about dividends? Don't lie. Dividends don't lie. Railroad companies, food companies, basic materials. Companies that are not going to explode on the upside when the market's going up, but on the downside, they offer downside protection. And what is this in our buffet? Oatmeal. Oh, boring oatmeal. Yeah, but it's good. It's good for you. Look at what it does for horses. And so instead of your 10,000 becoming 6,000 or 5,000, it might become 7,000 or 7,300. You see, it's still going to go down, folks. They're stocks. They're investing in stocks, but they're going to hold up well when the market falls. They're not going to do really well when the market's zooming ahead, right? Because it's a railroad company or it's a utility or a bank. But it's not going to fall and crack and dissolve in a pool of tears like many tech companies are doing, kind of like now. These classifications are just some of the major types of stock mutual funds. There are many, many more. So these are the ones we want you to internalize. These are the ones we want you to study. And of course, use the mutual fund scramble sheet for help with that. Now, we're going to get weird again. Because what we're going to do is we're going to overlay two more types of categories on top of the categories that we just learned. We're going to overlay the size of the company. Remember, large cap, mid cap, small cap, the papa bears, the mama bears, the baby bears. And then we're going to overlay yet another category of where is the company based. Is it domestic, based in the United States? Is it global, everywhere around the world? Or is it based outside the United States? Now, which do you think is riskiest with regard to large cap, mid cap, small cap? Well, as we discussed in chapter 12, the large caps are the least risky, the small caps are the most risky, and mid caps are somewhere in between. Why? Because large cap companies have the roots deep in the economy and they're better suited, they're better ready to weather a storm in the economy, a recession, a downturn. Small companies get blown apart, right? Something bad happens or new technology comes out. But when the economy comes back, they do really well. Why? Because they're more nimble. They're more able to take advantage of opportunities. Do you want to eat well or do you want to sleep well? Over time, small cap companies will do better than large cap. The ones that survive. The ones that don't survive, oh well. What do you think? Who do you think is the most riskiest with regard to domesticity? Domestic, global, international? Well, 50 years ago, 100 years ago, the risk was outside the United States, or at least more risk was outside the United States. So domestic were considered least risky. International were considered more risky than the United States, and global was somewhere in between. Well, you know what? That's not so true anymore. That's not so true anymore. It used to be that other countries did not have as good as standards as the United States, but now have some countries have better standards than the United States. And they're all looking at us and saying, me some too, with good reason, folks. There's a reason why the United States is the largest economy. Don't worry, we're not going to be the largest economy forever because we have far fewer people than China and far fewer people than India, and that just makes sense. But There's a reason why we're so powerful, and other countries want to be like us in regards to our business, which is, that's everyone's got their strengths and weaknesses. So what happens? It's like a pick one from column A and one from column B and one from column C. So that's why on the scramble sheet you see this mess of here. Oh, it's a global global large cap growth fund. Or no, it's a domestic small cap aggressive growth fund. So you start to see why there are thousands of mutual funds? Because the permutations and combinations, if you've taken statistics, yes, what are they? There are literally thousands of combinations that can be created using all these different categories. And as I said, these are only a few of the categories. Oh, you see what the mess we've made? Yes, it's a mess. And I think it's way too much, but that's me, I try to go look at older mutual funds that have been around and just do certain things well. But that's me. Other people want the newest whiz-bang mutual fund that they can invest in, and I wish them a lot of luck. Then there are regional funds. For example, you can buy a mutual fund that just invests in Japan or Canada or the Far East or Latin America. I don't think this is a good idea, but you decide. I like global funds, or some domestic, but I like global funds because I want my money manager to go anywhere around the world to find the best company. Because many times the best company's in the United States, many times it's not. You don't know. You need to do the research. And these mutual fund companies have people all around the world speaking multiple languages. Yeah. Now, but hey, say you've been down to Latin America or the Far East and you see that it's booming. Okay. Think of it like spice, on your buffet. Put a little bit on your plate, not a whole lot. Now, these two, sector and market timing funds, I call Dumb and Dumber. Maybe not. It depends on which sector you choose. But folks, we buy mutual funds, we invest in mutual funds for diversification. If you invest in a sector fund that only invests in wireless technologies or leisure companies or basic materials, you're concentrating your portfolio. And if you know something about that industry, you happen to work in that industry, okay, again, put a little bit on your plate. But in general, stay away from these things. Market timing, as we said back in chapter 12, nobody can time the market. People who think they can time the market are usually lying to themselves unknowingly or maybe knowingly, and they're lying to you, certainly. So just stay away from anybody who says they can time the market. The next category are the bond funds. So remember, bonds are less risky than stocks. So we're going to do the exact same thing. We're going to go from the most riskiest bond funds to the least riskiest bond funds. But wait a minute, didn't you tell me that bonds are far less riskier than stocks? Yes. The riskiest bond funds, the high yield junk, distressed, non-investment grade, speculative bonds, they do about as poorly in a downturn as the equity income funds. So they kind of look like stocks when they fall. They tend to pay very good interest, but they're more risky with regard to downside potential. So again, I wouldn't put too much money in these things. I don't like them, but that doesn't mean you might not like a little bit on your plate. And then there's the middle of the road corporate bond funds, anywhere from AAA to triple B, right? AAA, AA, triple B, and then maybe a little bit of double B. Remember the question? Do you want the double A bond that's paying less interest, or do you want the double B bond that's paying more interest? There's no right or wrong answer, folks. That's why there's a marketplace out there. You decide. I like middle of the road. I like, especially for older people. For younger people, we talked about the difference between bonds and stocks. Then if you're exceedingly wealthy, you might want to have municipal bonds because they pay you tax-exempt interest. We talked about these go back and look about why municipal bonds are very popular with very wealthy people. If you buy a municipal bond that just invests in your state, in your municipal bonds in your state, it will be double tax free. Oh, the IRS doesn't like that term. I'm sorry, IRS. Double tax exempt. The next category are the U.S. backed bonds and the U.S. bonds. Now, we discussed these a little bit in chapter 13. We discussed bonds. We discussed them more, of course, in Introduction to Investments. And there are people who make their living just in these types of bonds, folks, because there's just thousands and thousands of these things because they're tied to your mortgages. They're tied to people's mortgages. And there's an implicit, for many years, the Congress people would say, no, we're not backing Fannie Mae, Freddie Mac. We sponsored them, but they are private entities. And if they go bankrupt, oh my goodness. Yeah, the Treasury now, well, actually you, the taxpayers, own Fannie Mae, Freddie Mac. They're not candy companies, folks, or burger shop. They are companies that have thousands and thousands of mortgages and bundle them up and sell them as bonds. And they've actually done quite well, except they fell apart everybody else did too, so why shouldn't they, in the 2008 global financial crisis. And then the least riskiest bond funds, of course, are bonds that are tied to the United States Treasury, government bonds. And in 2008, they were the only thing that went up, apart from money markets, but they don't make a whole lot of money. So treasuries are the only thing that went up actually in 2008. It's called flight to quality. So again, most riskiest bond down to the least riskiest bond funds. And we're going to do the exact same thing. We're going to overlay two more categories on it. Now you remember domestic, global, international. So that's basically the same as it was with stocks. But now we're going to look at the maturity of the bonds. When do they mature? Do they mature long-term, intermediate term, or short-term? And you're tempted to think in terms of, long-term, large caps, short-term, small cap, and intermediate's kind of like mid-cap. No, they have nothing to do with one another. Don't confuse them. Long-term are more risky than short-term. Huh? Well, when you think about it, it makes sense. You're lending money to somebody. If you're lending money for 20, 30 years, there's a whole lot more that can go wrong than if you're lending money to somebody for 2 or 3 years. And of course, 4 to 7 years, it's 4 to 5 years, 3 to 5 years, that's intermediate term. So long-term are the most riskiest, short-term are the least riskiest, and then domestic and intermediate term are somewhere between the two, and domestic, global, and national, the same idea. So over on the bond side of the scramble sheet, we have the exact same, pick one from column A and one from column B and one from column C. Oh, this mutual fund is a domestic, long-term, high-yield junk bond fund. Yeah, that's why there's thousands of mutual funds, folks. Okay, next category is balance funds. Now, Piano, didn't you tell me that we were going to go from the most riskiest to least riskiest? And if a balance fund invests, in both stocks and bonds, shouldn't they be somewhere in between the two? Well, yes and well, no. Theoretically and in theory and practice, it doesn't always work out that way. When you mix stocks and bonds, you sometimes wind up with a portfolio that's less risky than all stocks or all bonds. That doesn't make any sense. Well, it's because that usually, but not always, folks, stocks and bonds move in two different directions. When stocks go up, bonds maybe don't go down, but they don't go up anywhere near as much as stocks. When stocks go down, bonds have a tendency to go up. So that not quite as rigid as the relationship of interest rates and bond prices, which is a true seesaw. And when one goes up, the other goes down, and vice versa. But stocks and bonds tend to move in opposite directions. So we like those balance funds. In fact, we want you to take a look at the presentation, maybe not now, but eventually, that shows you the balance fund in this chapter. We did better than the bond fund. We actually did a whole lot better in terms of our capital appreciation, in terms of what we earned. But we had less volatility than the stock fund. So they're a very good choice, especially for folks who are frightened by stocks or as you near or are in retirement. Now, again, we're going to throw another curveball at you. Be careful. And nothing's easy, right? Because there are other funds called asset allocation funds. Well, now how's that different from a balance fund? Well, it depends. Again, you have to read carefully, look at the history, look at what the mutual fund says about themselves. These asset allocation funds tend to be more tactical. That's the word they use. I don't know why. It's not a military. But they tend to say, okay, now's a good time to invest in stocks. Don't buy any bonds. Now's a great time to move out of stocks and move into bonds. So they could be a, closet market timing fund. Not all of them are. You have to be careful. But I like balance funds that stay balanced. And there's a typically 50-50, 60-40, 60% stocks, 40% bonds. There's a few reasons for that we go into in the second class, but don't worry about it. Yeah, the balance fund that we look at in this chapter in the presentation, I love them. They've been around since 1937 in one form or another. They market themselves as the complete investment program for the prudent investor. What a great, isn't that great? I mean, people are frightened as well. They should be. The ones who aren't frightened, they're the ones I'm frightened for. I'm frightened for them if they're not frightened when you're investing in stocks and bonds. And so here we are. We are going to be your complete investment program for the prudent investor. Yeah, I like that. Now, the least riskiest funds, and there's a line because this is where it ends. I didn't want to do a whole nother slide. I was lazy, I guess. But the least riskiest are the ones we've already talked about a little bit about. Money market mutual funds. And what you normally see is the mutual fund disappearing and the term money market. They say, hey, you got your money in stocks or bonds? No, I'm in the money markets. They're short-term investments. And they look kind of like a checking account. They pay more than checking accounts. And they used to give you checks. I don't think they do that anymore. Now they just want you to link up your bank electronically so that you can move the money from the mutual fund, the money market mutual fund, into your checking account. But I think some of them probably still have checks. Don't use it to go to the grocery store. You use it for writing big ticket items or depositing money in your checking account. So that was the mutual fund scramble sheet from the riskiest to the least riskiest mutual funds. Oh, I didn't put money market. There's balance funds. I should have money market down here. This is the new one. The old one was all handwritten. This one is semi-handwritten because I couldn't figure out how to put the characters in a circle. Yeah. Anyway, so make sure you study those categories in the mutual fund scramble sheet and in the presentation because I will be on the exam. But more importantly, remember, you're now the financial guru for your friends and family and coworkers. Now, what's this last one? This is a whole other world, folks. This is called life cycle funds or target date funds or retirement date funds. And these things are mutual funds of mutual funds. Well, yeah, sure. I don't mind being charged twice. No, don't relax. Because people are so confused when they see dozens of mutual funds in their 401k. They see thousands of you go to Fidelity's website. Fidelity's, they're really smart marketers, folks. You go to their website and you can literally, through Fidelity's website, when you log in, when you create an account with the website, you can buy over 9,000 mutual funds. You used to be able to buy 10,000. It's down to 9,000 something or other. Yeah. So the industry created these life cycle funds. So, for example, you walk into your 401k meeting and they say, oh, you're 25 years old. You're going to retire in 40 years, right? You want the Retirement 2065 fund. And what they do is they will have a whole lot of the spice. They'll have the growth in income, and then they'll have a little bit of equity income. And maybe what I don't like about them is they they put bonds in these things. Even though you're 20 years old, you're 25 years old, you're not going to retire for 40 years. You shouldn't have bonds. But that's where I differ from other people. I differ from other people. Some people say, oh, you should always have some bonds. But anyway, as you get closer and closer and closer to your retirement, they're going to move down the risk versus reward spectrum for you. They're going to do the asset allocation for you. So these things make a whole lot of sense. And there's another big reason. If your company automatically enrolls you in the 401k and they choose the retirement fund that is closest to your supposed date of retirement, you can't sue them. When anybody recommends, doesn't matter who it is, recommends a type of investment, and it turns out not to be a suitable, appropriate investment for you, you can sue them. Yeah. And so the Congress said, no, relax. If you use the proper retirement date fund, somebody's 35 would be a 2055. Somebody who's 40 would be a 2030 or something like that. No, that 2030. If they're 40, then 20 years from now would be 2040. I'm sorry, 2045. So I guess I'm a little bit off. But the idea is it's automatic. They look at your date of birth, they look about when you're going to retire, and they choose the appropriate target date fund or retirement date. They go by various names. Life cycle or lifestyle funds also. So you have to be careful. Okay, now. And now for something completely different. What? Yeah. As we said, there are thousands of mutual funds out there, folks. And so the competition for your dollars has gotten incredibly fierce. And so have the explosion, and so has the explosion of funds. It has gotten to the point where it is absolutely, in some case, ludicrous silliness, if you ask me. But it is something to at least be aware of, because again, you're going to have to choose a mutual fund unless you have somebody to help you, a financial advisor. So let's take a look at slide 13. What are these things called hedge funds? Well, actually, folks, they get lumped in with mutual funds, but they are totally different. They have different rules. They are they're different. There's different legal structure for them. They are traditionally only open to sophisticated investors. And these are supposedly people who could lose $50,000, $100,000 and it wouldn't be the end of the world for them. But now they've made it so that people with $5,000, $10,000 can invest in them. They're very, very dangerous. Sky high operating expenses. Some have done incredibly well, but a whole lot of them have fallen into a pool of tears. So stay away from them. There are funds that try to make money when the market goes down. Those are called bear funds, because the bear market is when the market goes down. You know, it's great when the market's going down, but the market goes up 3 times more, 4 times more than it goes down. So again, I would stay away from these things. We're going to talk about gold and other commodities. You can buy mutual funds that actually invest in gold. At least you hope it's gold. At least it looks like gold. They painted the lead gold. But we'll discuss gold and other precious commodities and precious jewels and metals and maybe, I don't know. They don't really do that well compared to businesses, stocks. And then REITs. REITs, what the hell is that? Well, actually, REIT is actually pretty cool, especially for those people who want to invest in real estate but don't want to be a landlord, or don't have the serious amount of money that is necessary to get into real estate. REIT stands for Real Estate Investment Trust. So these things we'll discuss a little bit more in the next chapter. They're actually not bad. They're not bad. The problem with REITs is that there's just not that many of them. So if you buy a REIT fund, a mutual fund that invests in real estate investment trusts, you're very, very concentrated in real estate, which, you know, has done okay, and actually has sometimes have done a whole lot better than stocks. So That's a way to invest in real estate without being a landlord. Not bad. Not great, but not bad in my humble opinion. Now, the industry, as we said, is so competitive, and sometimes it just comes down to this real silliness. There was a mutual fund called the Stock Car Stocks Funds. Now, what do you think they invest in? NASCAR. Yes, no, they don't invest in NASCAR cars. What they do is they invest in the companies that are the sponsors of NASCAR, because I know it's hard to believe for us here in California, but in San Diego, but the nation's #1 spectator sport is not baseball, not football, in person, I should say. People going to the events. It's NASCAR. 100,000 people get on a track, get in a stadium and watch people go around the track at 200 miles an hour. And what do they? Right, they have all kinds of advertising, and so the Stock Car Stocks Funds invested in those companies that were the sponsors. The Pause Tombstone Fund. Pause is the name of the company. Tombstone's the name of the fund. What do you think they invest in? Mortuaries and cemeteries and casket Hey, well, everybody's going to die someday. And so did the Tombstone Fund. And then you cannot make this up, dear students. The Chicken Little Growth Fund. You don't believe me? Go ahead, type it into your search engine. There was a mutual fund that was for people who were afraid that the sky was falling. There was the Timothy Fund for good Christians, and the fund, I forget the name of the name. There's a fund for Muslims. I mean, the choices are endless. And so are the fees. My advice, stay away from them, folks. Stay away from these boutique funds. Now, it's time to spend a little bit of time on index funds, because index funds and their cousins on the next slide, exchange traded funds, have become very, very popular. Why? Well, the idea was started back in the late 1960s, early 1970s, because it turns out that many mutual fund managers just don't do as well as the market as a whole. So get rid of them. How do you get rid of the people in the top hats? You simply buy all the stocks in a certain index. Remember, we discussed the Standard & Poor's 500, the Dow Jones Industrial Average, the Dow Jones U.S. Total Stock Market Index, which used to be called the Wilshire 5000, the EFA, the World Index. Remember these indices we discussed in brief in Chapter 12 when we discussed stocks. You simply, if you're the manager, the person with the top hat, all you do is you run down the list and you buy the stocks that are in that list. And if they're not in that list, you don't buy them. It's that simple. Well, why? Well, they can offer lower annual operating expenses, but be careful. Sometimes, mostly insurance companies, will sneak a high fee index fund into their mix of 401k plans, like they did at Southwestern. And index funds can become victims of their own success. And we don't want to go into that much detail of how that happens. We discuss it more in BUS121 Introduction to Investments. But just remember that no investment strategy that we humans have created is perfect. And when you hear people say, oh, index funds are the only way to invest, and they're the perfect investment, that's when it scares the living daylights out of me, because, everybody has advantages, everybody has disadvantages. And here's the kicker. They will tell you that no mutual fund can beat the index. No way. But there are many mutual funds that have beaten the indices over decades. So you want to look for a fund family, and we'll discuss fund families in our next presentation, where most all the funds have consistently beaten the index over decades. And there aren't that many of them. Given the fact that there are thousands of mutual funds out there and dozens of companies, it turns out there's only a handful that have done well over decades. Yeah. So they're the ones that, personally, I'm interested in, and we're going to take a look at a few you'll take a look at a few in the assignment sheet that have been around for decades and have done well in good times and, most importantly, bad times. Cool? And so index funds, their popularity has spurred another type of fund called an exchange traded fund. This fund is very similar to index funds, at least that's the way it started. They're traded, though, like a stock, whereas a mutual fund is traded once a day. At the end of the day, they look at the price at the end of the day. These things trade throughout the day like stocks. They, too, most of them will have very low annual operating expenses, even lower than the index funds, and there's some reasons for that. But you do incur brokerage commissions. Now, here's the I said Fidelity was a very smart company. They did it, and now, of course, other companies are following suit. They said, look, if you buy our ETF through our company, we'll waive, W-A-I-V-E, we'll waive the brokerage fee. We'll waive the commission. And Fidelity did one thing more. They waived the annual operating expenses for, I think, 3 of their ETFs. So, folks, I mean, how low can you go? You can't get any better than free. But remember, you're accepting the market return. You're not getting better than the market, but you're also not getting worse than the market. Now, remember, nothing's easy, right? There are now exchange traded funds that are not index funds. They are actively managed. The people in the top hats go out and knock on the doors of Ford and Chevy and GM and Toyota and Honda and BMW, and they do active management. They just don't run down the list and buy the stocks that are in the list. Of course, the fees are going to be higher because that costs money. Good research costs money, especially because the world is global. So this is where, things blur. ETFs all started as index funds, which meant they didn't do any research whatsoever. Now most of them still are index funds, but now there are ETFs, exchange traded funds, that are actively managed and have higher fees. And as we said, they can be bought and sold throughout the day, whereas most mutual funds, at the end of the day, that's the price you get. So are you thoroughly confused? Good, we've done our job. No, it wasn't our job. I mean, some people think that the industry makes things overly complex just to confuse the individuals, but I think more along the lines of just trying to compete and trying to and doing things that are not necessarily, in my humble opinion, in the best interest of the clients. But hey, if it sells, how can you argue with that? Until it falls apart into a pool of tears, and right. And that's happened a lot, folks. These newfangled mutual funds, newfangled strategies and the like were so oversold. And as the music was playing and everybody was getting rich, everybody was all fine until the whole bottom fell out. That's why I like mutual funds that have been around for a long time, done well in good times and bad times. And I'm stealing the thunder from the next presentation, because when we come back to our final presentation in mutual funds, we will take a look at some fund families. And then we will concentrate on a single mutual fund that has been around for 88 years. Been around for almost 90 years and done well in good times and bad times. And I'm not trying to sell you this fund, folks. We have to start somewhere. We'll see others, don't worry. But come back when we take a look at fund families, and then take a look at a sample mutual fund, and tie and finish up with a few thoughts about mutual funds and how to invest. Cool? Okay, dear students, we're so proud of you. Stick with us. You are awesome.